Hey everyone, it's Wolfgang. I want to talk about scaling up an investment real estate portfolio using the right type of loans. So most of us know that real estate investing leads to wealth. It's not overnight, but it happens over time. It's an incremental, gradual process. It's quite worth it. I've been doing it for quite a few years. And when I started investing in real estate, getting loans for self-employed people, I was self-employed at the time, was pretty darned easy. They were called no-doc loans. And if you were a self-employed person, if you were a doctor, a dentist, an attorney, a self-employed software engineer, you could get loans to buy rental properties. You could show your assets, like your liquid assets, bank accounts, brokerage statements, and get a loan to buy investment property. In 2008 and 2009, there was a real estate crash. We all know that. Lending standards changed pretty dramatically. To get a loan, you needed to show proof of income. These no-doc loans, showing your assets to get a loan, were no longer normal. In the beginning, you could walk into a lender and say, look, I'm self-employed, I've got a rental property I want to buy, what are my options? They would say, a no-doc loan, or a loan where we verify that you can make the payments because you have enough assets, you have enough savings. You did not need to have enough assets to pay the loan off, but you had to have like a runway, a certain number of months where they could say, even if you're not making an income for a while, you still have the means to make the loan payments. So back in those days, before the crash, it was pretty easy to walk into lenders, loan brokers, and get a loan. The 2008 and 9 crash switched the lending standards. They tightened down. They really tightened down the screws too tight. You needed to show proof of income. It became hard for investors to get loans to buy rental properties to scale up their portfolio. Even today, a lot of investors, I have an acquaintance who's run into this recently. They're not aware that self-employed people can get loans to buy rental properties. The problem is common lenders like credit unions and banks do not make these kind of loans. And I'll go into why that is as we go through here. What I'm going to do is I'm going to explain the options for real estate investors to get loans to scale up their portfolio, because we all want to build wealth. There is a way to do it despite the changes that came after the crash. So if you're new to real estate investing, you sort of have to talk to non-proof of income lenders. If you walk into your credit union or your bank and say, I'm self-employed, you could be a doctor making $1 million a year. If you're self-employed, it's more difficult than someone who is an employee of a company who, by the way, could lay them off tomorrow and they'd have zero income. Nevertheless, it's still easier for someone with a W-2 to get a loan compared to someone who's self-employed. That was one of the changes that occurred after the 2008 and 9 crash. So contemporary real estate loans, institutions like credit unions and banks who make contemporary real estate loans, they have to meet debt to income standards because they sell their loans on a secondary market. The way it works is this. The bank makes money every time they make a loan in fees. They make fees from creating the loan. They make the loan, and then they earn the fees as their profit, their income, and they hold the loan for a year, and then they sell the loan on the secondary market. So the secondary market has standards. The secondary market says, look, Mr. Credit Union, if you want to sell us your loans, you can only sell us loans where you can demonstrate you qualified the borrower using the following standards. And the standards were debt to income ratio. You cannot have too much debt. We all know cars are expensive these days, right? If you buy an expensive new car and you think you're going to be able to buy rental property through these traditional contemporary real estate lenders like credit unions and banks, it becomes very difficult. They have a debt to income ratio standard. The secondary market tells them you have to enforce certain standards on your borrowers. You have to qualify anyone who takes out a loan from you, or we're not buying your loan from you. And the lenders, they need to sell those loans after that year so they can get the money and make another loan and make fees. So some of the standards are debt to income ratio. You can't have too much debt. You have to have a certain credit score, and it's generally you have to have a decent credit score and job stability. And there are other things too. Being a W employee is basically required for credit unions and for banks. You can find exceptions. You can find exceptions, but a lot of banks and credit unions, they sell their loans on the secondary market. FHA, VA, USDA, Fannie Mae, Freddie Mac set these standards that these lenders enforce on their borrowers. So after 2008 and 9, after that crash, if you were a real estate investor, it became all of a sudden, wow, how am I going to keep growing my portfolio? So there's always been demand from investors, and demand always leads to someone giving a supply. So demand leads to supply of loans, and you can now get loans if you're not an employee, if you don't have W-2, not necessarily from your credit union or bank, but you can get these loans. So here's what you need to do to be able to grow your portfolio if you don't have W-2s, if you're not an employee. Call lenders and ask them if they offer investor cash flow loans. If they say no, or I don't even know what that is, don't waste any more time. Hang up and find one who does. Generally, some lenders do offer this type of loan, and some don't. Some lenders will not sell the loans on the secondary market. They hold them for the long term. And those lenders will grant loans to investors. But a lot of the credit unions and banks won't. So if you do find a lender who makes investor cash flow loans, the interest rates are usually a little bit higher, and the loans are not sold on the secondary market. So what this means is investor cash flow. What the qualification to get the loan becomes is how much cash flow does the investor get from the property? Are they making enough cash flow from the property to make the debt payments, the loan payments? So there's a couple of different types. Well, actually, there's more than two, but a couple of different types of these loans, these investor cash flow loans. The first one is the debt service coverage ratio loan. The rental income divided by the debt payments. This is principal, interest, taxes, property insurance, and if there's an association fees related with that. This is you divide the rental income by the debt payment. It's a ratio, debt service coverage. Does the rental income cover the debt payments, the loan payments? Debt service coverage ratio generally needs to be at least 1. If you find a lender who makes this type of loan, they will say you need a debt service coverage ratio of at least 1. The loan is based on the property income. You do not have to prove income from a job. You can have a job. You can be a self-employed person making a decent income. You can be a W-2 employee making a decent income. But if you're growing a real estate portfolio, you decide to use this type of loan, they will not even bother you with asking you about your income from your job. They're going to qualify you to get the loan based on the rental income from the property. That's a debt service coverage ratio loan. They will not ask you to provide tax returns. Generally, you'll have to have a credit score of 600 or higher, and you'll have to have some skin in the game. They'll want you to have 15% down or higher. Now, I want to say one thing about these qualifications. These are the qualifications to get this type of loan. There is some variance in these qualifications. There's not too much variance from if you get a credit union or a bank loan for a house because they have standards being enforced on them by the people who buy the loans from them. The secondary market imposes standards, so there's a lot of uniformity in what they will ask. In other words, you can talk to 10 banks and 10 credit unions. They will all say the same thing. You need to have a job. You need to have a W-2. Your debt to income ratio must be a certain number. You've got to have a 700 credit score or higher, job stability, 2 years on the job. There's not a lot of variance. It's pretty consistent. They all ask for the same thing. With these guys, they're not selling their loans onto the secondary market. So there can be more variance in what these requirements are. So keep that in mind. Okay, so that was the debt service coverage ratio loan if you're a self-employed person. If you're a doctor, a dentist, an optometrist, an attorney, a self-employed software engineer, a tradesperson. Another option is a bank statement loan. Let's say you're a tradesperson, you're a flooring installer, and you work for property managers who pay you on a 1099 yearly. They give you a 1099. You can get a bank statement loan. That's a 1099 loan. That's another type of loan. Let me take a step back. A bank statement loan. Let me talk about bank statement loans. This is for self-employed people who do not have a W-2. If you find one of these lenders who will give you a bank statement loan, they will ask to see the most recent 12 to 24 months of your deposits. They want to see that you're making large enough deposits on a regular basis to pay the loan payments. So in other words, they're not looking at rental income. They're looking at how much you're depositing. The debt to income, they will let you go up to 50%. In other words, if you're spending half of your income on debt, that's the most that they will allow. They do have credit score standards. but they won't ask for tax returns. These guys will always ask for tax returns and a bunch of other things. They just, there's just not a lot of options with these guys. They want to see basically your entire life. If you have regular bank deposits you're making, they don't care about your tax returns, and they don't really care about your the fact that you don't have a W-2 because you're not an employee. They want to see that you're making regular bank deposits. So I didn't have room for all the different loan types here, so let me just mention a couple of other ones. A 1099 loan, that's the one I mentioned earlier. A 1099 loan, if you get paid on a 1099, like every year someone has hired you throughout the year, maybe you're a tradesperson doing flooring for a property management company, and they send you a 1099 showing how much they paid you. There are loans some of these guys will offer if you present them with 1099s. That's sort of your proof of income. Another option is an asset loan. Asset loans, they use your assets for collateral. If you say have $1 million or $2 million in a stock portfolio, they can use that as collateral to give you a loan to buy property. It's sort of somewhat like what was available when we started investing in property. They would look at your assets to see if you have sufficient assets, and they say this person has their act together, they're going to be able to make the debt payments. So this is probably the most common one because it's a rental property income based loan. Does the property make enough income? So the more units you have, the easier it is to get this type of loan because the rental income is higher. So there is one thing I want to say about a little bit of the frustration that comes if you talk to your credit union, if you talk to a bank and you say, I have heard that there are investor cash flow loans. Some of these institutions have policies to not talk about competitor products. These guys want to sell you, the banks and the credit unions, they want to make fees from loans that they have. If they can't make you a loan from their institution, they're sure as heck not going to talk about other options you might have. So if you're new to real estate investing, it can be a little bit frustrating to hear from these guys, you either do it our way or there's no way to do it. So don't listen to that. This is an option. Basically, some of these institutions are competitors to these guys, and so they're not going to try to help out their competitors. If they have some grace, if they're more humanitarian, some of them might say, look, you're self-employed, there are some options. I have a contact who does investor cash flow loans. You can find that too. But a lot of credit unions and banks are like hardcore. If we can't make, the bank employees are told, look, if you cannot qualify a borrower for one of our loans, you're not allowed to mention any other products. It's just a competitive thing. They're in business to make fees for making new loans. If you have any questions about any of this is kind of a cool breakthrough because after the crash, it became kind of discouraging about the loan situation, getting loans to grow your portfolio because real estate investing leads to wealth. If you can't grow the portfolio, it's hard to build your wealth. So ask me any questions in the comments. I'd be happy to answer those. And I want to thank everyone for watching and have a great day.